There we go. Okay, let's start.
Hey, good morning, everyone, and welcome to this session of Accounting Design Project. I'm Ionela Andrejkovic from Frankfurt School, and I'll be moderating this session. Today, we have two exciting presentations on the valuation of intangible capital, with each presentation lasting 45 minutes. Please feel free to turn on your videos so that we have more active participation. And talking about participation, please use the raised hand function or just ask your question by typing in the chat. The first paper is entitled Value of Internally Generated Intangible Capital, and is co-authored by Anil, Anup, and Rong for Calgary and Shivaram from Columbia. I think Anup will present the paper. Anup kindly asked everybody to have 5 minutes uninterrupted at the beginning of his presentation before you jump in with your questions. So Anup, the virtual floor is yours.
Well, thank you very much. Thanks all. It's great to see so many friends' faces. I see Fabricio there, Matthias there. Panos hasn't turned his video on yet because it's too early in the morning. So I'll take 10 minutes, not 5 minutes. And I specifically request you to go first because I've seen Ethan's paper and it's so much better than ours. He's going to steal the thunder. So I thought I will go first. The title is Value of Internally Generated Capital. The context is well known to us. Firms spend on intangible investments to create future value. They invest on innovation, human capital, which Ethan is going to talk about, marketing, brand, customer acquisition, information technology, so on and so forth. However, current accounting requires these investments to be expensed as incurred and not recognized as assets on the balance sheet. So if you look at reported assets, they are deficient to the extent of not reporting or not including a very important asset, which for many companies today, more and more companies, it's becoming the most important asset. Now, users of financial statements, they rely a lot on reported assets. Here are some examples: a residual income valuation model, pharma and French HML, which is arguably the basis for value investing, and tons of ratios which are used by analysts and lenders and creditors, which are all based on book values. And so if book values are deficient, then this whole financial statement analysis is also deficient. The users of financial statements have come out with their own home-based solutions. For example, they reconstruct book values in the absence of their reporting by the company. They capitalize in-house intangible investments using what is called as perpetual inventory method. Basically, what we do in capital expenditure, capitalize all investments and amortize them at a pre-specified rate. For example, Peters and Taylor JFE paper, which I'm going to talk more and more about. So now, two big assumptions required for implementing perpetual inventory method. First is how much to capitalize. So we know that firms' intangible investments are reported in Sgna, but what percentage of Sgna investments or Sgna outlays should be capitalized? Second, how much to amortize each year? So yes, you have a stock value, but how much should be depreciated or amortized each year? Now, the current studies are relying on some mechanical rules of thumb. For example, many studies are using 30% or 50% or 100% of Sgna as investments, irrespective of the industry. So a pharmaceutical industry, a pharmaceutical firm is presumed to spend same percentage on investments as a steel company or a service company. So that's the first deficiency. The second is that the studies are assuming that the useful lives and therefore the amortization rates or the depreciation rates are same across all industries. Where do we step in? We say, okay, we are going to help this out because there is a great demand from practitioner as well as academic research. For example, Peters and Taylor is already cited by 505 studies. And Words Now reports a revised Tobin skew based on this mechanical capitalization. And many people are already using it. So we are going to provide a solution which is to calculate industry-specific capitalization rates and industry-specific depreciation rates for R&D and Sgna. So what's our approach? Sgna, we first divide it into R&D and what we call as main Sgna. So divide Sgna into two components, and then further divide these main Sgna and R&D into three components. The first that supports current operations, what we call as maintenance R&D or maintenance Sgna. The second is the one that produces future benefits. And we're going to look at future revenues as future benefits. And the third one, which ex post turns out to be wasteful. It may not be ex ante wasteful, but ex post turns out to be wasteful. So how do we identify that? We estimate a regression. I'm going to spend some time on this. So we regress, let's say R&D on current revenues. So this is current revenue. And then we include a series of future revenues in the regression. And this regression is estimated on an industry basis. And we try 7 different regressions. In first one, we just include the current revenue. In the second one, we include current revenue and 1 year forward revenue. In the third one, we include first current revenue and 2 future revenues, all the way up to 7 revenues. So 7 different equations. And we identify the equation that has the highest adjusted R square. Okay, and that we assume that is the most optimal model for that industry. So we have looked at R&D and we have looked at what are the future series of revenues that this current R&D is associated with it. So it kills 2 birds with 1 stone. First, it helps us identify the investment portion. So the maintenance portion is the one that is associated with current revenues. The other term is a wasteful component. And the one that is left, which is the intercept plus the portion that is associated with future revenues, is an investment portion. That's we assume as investment portion, plus the number of leads included in the model. So if it is associated with 3-year forward or 4-year forward or 5-year forward, gives us the life of R&D. So 1 divided by life of that investment, assuming straight line depreciation, gives us amortization rates. So quickly present and same thing for main Sgna, we do that. I'll quickly present some results. As you can see that the proportion of investments in main Sgna differs across industries. Proportion of investment in R&D differs across industries. Optimal number of lags, that's the leads actually. What is the future life of each investment also differs across industries. On average, so in fact, here's the key takeaways. Percentage and useful lives differs across industries. R&D is not entirely 100% investment. We find it approximately 77%. Sgna percentage, which is investment, is not 30%, not 50%, not 100%, but 54% on average. Useful life of R&D is 5 years on average. Useful life of Sgna is 2.7. This is the most important finding so far because it's much smaller than what has been presumed in the prior literature. Prior literature assumes it at 5 years or 7 years. On average, okay, Matthias says 6 years. So ours is much smaller. So if you look at capitalized assets, it's going to be much smaller using our method. Then we implement the perpetual inventory method. We calculate the capitalized value of R&D and Sgna. And again, to summarize, we recalculate retained earnings, book values, earnings per share. Here is a summary statistic by industry. As you can see, for pharma, the book value almost doubles. So capitalized book value increases by 91%. On the other side, the market to book ratio declines because the market is still the same, book value is expanded, and therefore market to book ratio, it comes closer to 1. And in fact, the variance of market to book ratio also decreases. Now, how do we prove that our numbers are superior compared to book value? We conduct 3 tests. So we recalculate all the ratios. We conduct 3 tests. The first test is we see whether our revised book to market is associated with future returns. So returns is T plus 1, book to market is in T. This is the basis of Pharma French HML or value investing. This is a risk adjusted 5-factor model. And we find that our book to market, which is our modified value, is more strongly associated with returns than reported numbers or Peters and Taylor. Actually, if you use mechanical capitalization, you can see there is a slight decline. You're worse off by using mechanical capitalization than compared to reported book values. So we outperform both Peter and Taylor and reported numbers. We look at Tobin skew association with future investment. This is the main test in Peter and Taylor. And we find that on average, we do better. We have the key variable here is R square, and our R square is much better. And in fact, it's even better for intangible intensive industries. Finally, we look at predict Altman Z-score, which predicts bankruptcy for manufacturing industries. And it uses a lot of ratios. We recalculate those ratios, and we find that we outperform both Peter and Taylor as well as reported numbers. So in summary, I think we provide an estimate or a solution for consumers of financial statements. It's a very narrow scope, but a very important scope. Those who are using mechanical capitalization, 30%, and 7-year lives, we are providing you a better solution. So for lenders, investors, analysts, those who are relying on financial statement analysis, we provide a better solution. Now, arguably, we also contribute to the debate on capitalization. Whether, at least in our narrow context, we find that capitalized numbers are more informative to users of financial statements than just the reported numbers. However, we admit that we have not conducted a full welfare analysis. We haven't looked at what are the costs of reliability or opportunistic aspects of the reporting. But at least in narrow context, our homegrown method of capitalization outperforms the reported numbers. So this in summary is the paper, and Ionela, if you can, I hand it over to you.
Okay, I think Stefan was the first asking a question, and then Zachary. Stefan?
Is that me now, Stephen? Okay.
Yes.
Anoop, I congratulate you on pressing on this issue, because I believe the whole issue of capitalization of these expense investments rides on the amortization rate. It's no use capitalizing it and have amortization rates which just destroy your earnings, and so you don't know what you're making. Okay, so I think pressing on this is very important, and I think that's the key to people say, well, we should capitalize intangible assets, but they don't understand this concept for the income statement for earnings. And unless you have good amortizations, you're not going to get good measures of profitability. So it's a very, very good endeavor. I have some reservations, however. Okay, you're looking at industry averages. Okay, and I think the idea in accounting is that we want to distinguish an individual firm from the average. Of course, we can apply the average, and the accountant's giving you no more information. Okay, and it's important, particularly with R&D, which tends to be a unique activity in a firm. Okay, one you get a patent for which no one else can use. Okay, and so I'm not sure whether looking at industry averages actually does it for you. Secondly, I would worry that you're looking at successful firms, R&D, which is successful. Okay, and so you've got an exposed bias here. Okay, that the R&D that's not working is not there. Okay, and a lot of R&D doesn't work. And following on from that, I think if you use averages, you're going to find that what happens to your earnings later on, you've either got to have impairments, okay, because the average is not working for you. If your R&D is not as good as the average, so you're not picking up the impairments, which are actually an amortization of the initial capital investment. So these are my concerns, and things are one that I would encourage you to press on, because I say this amortization issue is very, very important to the whole issue of capitalization. But those are the reservations I have on the basis of what I see in your paper at present.
Yeah, thanks, Steve, and thanks for inviting the paper. So yeah, these are very valid points. First, I think the first point you made was amortization is important. In fact, I concede that the other 2 points that you made, I do not have responses, and I totally agree with you. And our methodology is deficient to that extent. However, on amortization rate, all I will say is to those narrow segment of people who are using some mechanical numbers, we provide a slightly better solution.
Mm-hmm.
Okay, so Matthias is on the call and he indicated to me with his hand he's using 6 years. And we say, okay, it's nowhere near 6 years. The biggest chunk is Sgna, and we find it on average, weighted average is 2.7 years. So at least all I will say is that in the spirit of science, we are making one step forward. And we are nowhere near the goal, nowhere near perfection. So I think that amortization rate, in fact, we find, Steve, surprisingly, we find that our capitalization rates are higher than what has been used. So we actually find 50% instead of 30% that is currently being used. So we find capitalization should be higher, but depreciation should even be much faster, 2.7 years and not 5 and 7 years. So our values are actually lower than what has been used in the industry. So that's your first point. The second point that you made was, which is actually, which I don't have response to, is firm specific by definition, as you rightly said, that these intangible investments are to create some unique competitive advantage or a unique moat or protective barrier for the company. And we are looking at industry averages. All I will say is that we have taken a step forward, 30% uniform to. So that's the spirit. The third point that you made was, which is very valid, is the survival bias. We need 7 years to calculate our data. And by definition, R&D for many companies, it's a lottery ticket. Either they do very well or some of them fail. Many, biotech is a classic example. Luminita does research on that. 4,000 products and one becomes successful. 4,000 molecules they started and one is finally launched and becomes successful. So by definition, our data is based on survivors. Again, all I will say is, I think to our defense, all I will say is that we are offering a better method compared to a mechanical method. And arguably in that narrow segment, we are doing slightly better.
Yeah, I think differentiating, are you doing it for the studies like Peters and Taylor that are using these measures in research versus for accounting? He's proposing as accounting prescriptions. I can see getting some better measures on average might help you in certain research investigations and asset pricing. For example, constructing an asset factor. But for accounting, I think it's a little different. You mentioned the number 2.7 years. It might be worthwhile to think, you say it's much shorter, 2.7 years. Well, you might be able to model it. Given the uncertainty, it's 2.7 years plus or minus 2 years, 3 years standard deviation. You might, as an accountant, say, well, damn it all, it's so uncertain, I'm going to expense it now, okay? Because the probability I'm going to have an impairment in the future is just too high.
Yeah, I think I agree with you. I think we're not approaching it from the accounting perspective. We are perhaps approaching it from the user perspective, because as we see, in fact, I have paper on value investing, and we did a minor tweak on HML factor, and we showed that it works much better. So suddenly we were surprised to see at least 20 papers on the same topic in finance. And each one of them has their own homegrown solution. And it's based on some mechanical assumptions. So I think we are talking about that narrow segment. Going back to, we have had this debate earlier, from accounting perspective, we need to start with disclosures. Let's start with disclosures. At least currently everything is in that bucket called Sgna. We don't know what is there in this. So. Yonela?
Okay, thank you. Next, we have a question from Zachary.
Yes, thank you. Anoop, I thought it was an interesting paper, and I think it's a really interesting observation that a lot of research uses the sort of a mechanical rule that they apply to every firm in the sample. But as I was reading, I was sort of wondering, well, there's already, in terms of just developing industry-specific amortization rates, there's been work done in that area by Lev and Sgna, and I think there's a more recent publication that applies that method to Sgna, where Lev and Sgna is more of the R&D piece. sort of wondering, how does your method compare to that? And have you thought about using these other industry-specific measures to see if you're even better than those measures, instead of just comparing just to the mechanical one-size-fits-all rule?
Zach, thanks for your question. Thanks for coming for the presentation. Can we request you to send that Sgna paper? We are aware of R&D. And in fact, there is another paper which is in AER, Lee and Hall, which looks at, which identifies R&D. We would actually look forward to it if there is anybody who has done specifically for Sgna amortization rates. I know there's one paper which is based on acquisition. Are you talking about the one that uses acquisition data?
I haven't read it in probably a year, but I don't think it uses acquisition data. I think it uses large sample data, and it basically just applies the Levin-Suggianis framework to Sgna. I think it's
Okay.
Banker et al. in TAR 2019, but I'll send it to you.
Yeah, in fact, Banker and et al., we make a slight modification. I think I should mention it. Banker et al., in fact, we flip the left and right hand side variable. So Banker et al. Is so we are looking at R&D and future revenues on the right hand side. Banker et al., the investment is on the left hand side, and you have series of operating earnings on the right hand side. We initially started with that. We believe that there are some issues with that model. This is much better approach where we have R&D on the left hand side and series of future revenues on the right hand side. So two differences we highlight. First is they're based on impact on operating profit, while we are looking at impact on revenues. So that's one major twist. Second thing is, again, it might be a simple switch between left and right, but I think it helps us better identify R&D that is associated with future revenues than the other way around. So we are aware of those models we are aware of, but if there's a model that we are not aware of, we would look forward to. Thanks for the point.
Sure, I'll send the paper. It sounds like you are already aware of it, but I'll send the paper. And I'll just say, I think it would be an interesting analysis to estimate some of those models and show that your model does better. I think that could really sort of help the paper and help that comparison. But
in fact, I think I'll request the audience, if you can think of any way of saying that our mousetrap is better. We are currently doing a returns test. We are doing a bankruptcy prediction, and the third one, which is the Tobin skew and investment. If you can suggest any tests, we look forward to suggestions, and we would be happy to do that. Yonela?
Oliver, do you want to unmute yourself and ask your question?
Yeah, thank you. Also, thanks to Anoop for the nice presentation. I just have two quick questions. The first one relates to the previous one. So I think, again, I applaud you for tackling this challenging topic. But, with the challenging topic, there are also a few other working papers at the same time right now that try to do basically the same thing as you guys. One has been presented here, actually, in this workshop in spring by Sean.
Yep.
And their estimates, so they use a structural model to derive their capitalization parameters, and they are quite different from yours. So the first question is whether you guys have thought about what derives these large differences. And the second question is, so right now you're using revenues as basically your independent variable. But when I think from an output perspective, I would think of using production as the variable if I use it from a depreciation perspective. And if I use it from a valuation perspective, so if I think about value, then I would use profit instead of revenue. So I was a bit struggling just conceptually with why you wouldn't end up with revenue rather than output approach, production, or valuation approach, profits.
A good question. In fact, we are aware of those papers. All I will say is that there are several people trying to estimate, it's homegrown solutions at the end of the day, and nobody knows what's an ideal one. So there's no gold standard against which we can test ourselves and say that we are better than A or B. And we are all like six blind men trying to feel an elephant and try to figure out what the elephant looks like. So that's my response. We are aware of Sean's paper, and that's based on acquisition. So it's based on acquisition data, which to me is a great method, The couple of problems, it is based on a limited set of firms and limited set of firms that do acquisitions. Second thing is we know that at the time of acquisition, firms allocate allocation value to individual, and it's quite arbitrary. A lot of it goes towards goodwill. We know that. So I don't want to cite Sean here. It's a great idea. In fact, it had been my first preference to do it, but we know that it also has limitations. Your second point was whether to use production, revenue, or profits. Production is by most firms, and production is not even folk. Then it comes down to revenue versus profits. About it, and in fact, what Lev and Sgna do is they recalculate profits as if R&D was not capitalized. What would the profit be? Possibly one way of doing things. We have gone towards revenues because I think, at least for intangible intensive industries, firms trying to establish market, winner takes all market. They're trying to get as much market share, prove themselves the player. As we know that for many of these firms, if they meet earnings targets, it's okay, but they miss revenue targets, the stock price declines. Revenue is driver for, and revenue being the best proxy for market share for winner takes all establishment of your product or idea. As so point well taken, we had to make a choice. We went with revenue. I will say that I have a management science paper, which is also based on revenues. And with that, it was a design choice, and we discussed pluses about that method. So
Fair. Thanks, Anup.
Excellent points. All I will say is, again, we are all sick groping in the dark. This was fun.
But if I can just interrupt there, I don't see the point here. I mean, we amortize to match against revenue. That's the matching principle. We don't choose depreciation based on the profits. We tend depreciation based on the match to revenues, right? So shouldn't it always be revenues?
But why do we depreciate based on revenues?
Because the income statement says, here's the top line, here's what I'm getting from customers, here's the cost of serving those customers, to give you the value, the markup, the value added. So that's the matching principle. So if you're making negative profits, project negative profits, the idea is you have reverse amortization. Doesn't seem to make sense. That is the amortization should be based upon how much am I making from my customers after the cost of my investment.
Did we lose Anup? Yes.
Well, that wouldn't be very good.
We lost Anup, but I think Anil is here. Anil, do you want to
take the questions?
Some questions?
Sure.
Okay, so we have next question from Jose Elias.
Yes, thank you. Nice presentation, nice paper. I just have a short suggestion. I was wondering during the presentation if what would happen if the main model, the first model, is estimated using median regression or quantile regression instead of average or original least square. Because when estimated by industry, you have a lot of different companies, firms with different perspectives, strategies, etc. When you use a median regression, at least you can compare the difference for the next models, what can happen, what the effects of the median regression, the estimates of the models, on the consequence of that. Just a short suggestion for robustness, for example. Just that.
Right. No, I will definitely consider that and see if that makes any difference. Sure.
Okay, thank you.
Will we continue with the questions like this? Anil, are you taking the other questions as well?
Sure, I can take that.
Okay. So next we have Sudipta.
Hi. So to follow up on Stephen's point earlier about firm-specific information, I was thinking of at least two situations where we have some of that information. So one is outside the US, if you think about development is capitalized. So that's part of the research that the firm chooses to capitalize. And so they're providing information on success. So that's a case where you could compare your estimates, industry averages, against the firm provided information on what are successful projects and sort of see whether you beat that. Similarly, in the US, you have software capitalization, again, which is sort of similar, that the firm is choosing that information. Or you can look at oil and gas exploration, where again, you have a choice between capitalization and expensing. So there are cases where we are getting firm-specific information within industries, though, in the US, but also the US across industries. And it would be good to see whether that firm-specific information is as good as the industry averages or worse than industry averages because of opportunism or proprietary costs or whatever the other things are. But I think you have a good benchmark to start with in terms of improving accounting practice.
Yeah, that helps. And I actually, we thought about it, and what we noticed is, firms which are using IFRS, where they have a choice to capitalize development portion of R&D, a lot of these firms are still not choosing to capitalize. So, there is that decision point of whether firms are doing what they're, what they have a choice to do at that point as well. So if it were that all firms which have a choice to, capitalize development cost are capitalizing, it would be much easier to use them as benchmarks. But we can still look into that.
Ayung, do you want to ask a question, or do you want to continue, Sudipta? Sorry.
Just one other question. I was thinking again about that other question about what should be on the left and what should be on the right. So it seems to be the more natural way would be to have revenues on the left and R&D on the right. R&D that you're arguing causes revenue. And so I would have put in R&D in period T and then R&D in previous periods on the right-hand side and revenue on the left. So Anup says that flipping it around is the better way, but I want to understand the logic for why it is better to have what your causal variable is on the left and your cost variable on the right, which is the future revenues. Why is that a better estimation method?
Yeah, I don't have a quick answer to that, but I'll think about it and see how these two compare.
So 3D Hurt and Sider, 2000 JE has a paper on the reverse specification versus the forward specification that you should look at.
So Sudipta, I'm going to step in real quick here because I have faced this exact challenge. If you put multiple years of Sgna or R&D on the right-hand side, what you end up with is severe multicollinearity in the regression because these numbers are just extremely persistent. So I think they're actually making 100% the best decision empirically there, because if you start throwing a bunch on the right-hand side, you get into some statistical problems.
Yes, but that also sort of says that you're not really doing a good job when you put the variable on the left. Then simply sort of being able to estimate it is not the same thing as understanding what's going on. But sorry, I don't want to. Next question, I guess.
Seems that Anup is back.
Yeah, I'm sorry. I had to, I don't know. This is the first time it has happened in 2 years, but it happens at the most important point, right?
Always the case. So Ayung, do you want to ask your question, and then probably Anup can answer now?
Yeah, so I think Anup, like when you were asking us to kind of like give you some suggestions, we're academics, we never shy to say so. So there are a lot of choices in your model, right? Like the first, you try to kind of group the universe into 48 buckets and try to estimate that. That's kind of relates to Steve's earlier point. And then you continue using this linear regression, and then also have of your choice of a future revenue rather than other kind of output measures. So I'm just wondering that, have you think about some out of simple period or out of a simple firms test? Just try to help us understand what does that 2.8 years or 2.7 years really mean? In addition to what Sudipta just talked about, that's have a industry specific and a validation of that estimate. Each estimate will help, but like I think I would be curious about what's your out of sample period or sample firm test result will look like, and then the other thing, I think the fundamental question is that what would be the benchmark you would use to kind of to say that the model actually works out of sample? Is that predicting future returns or predicting firms' operating earnings or productions or revenue? What exactly is the utility function that's of the agent you really cared about in your study? And then to satisfy the utility would be the benchmark you use to actually judge whether out of sample test actually successful.
So lots of questions rolled into one. First of all, 48 buckets, we had to make a choice. We also need long data, and we need certain number of, so imagine if you have 7 terms, actually 8 terms on the right-hand side. So you need certain number of observations. And so we can narrow down the bucket, but then we lose a number of observations. So it's a classic trade-off. Going back to Jones' model or Sugata, Roy Chaudhury's model. So we had to make a choice. The second question was, again, I think we can try. We can do these trade-offs. Anil, very bright PhD student, he has run the model, and Rong is there. She has guided the whole process. So we'll try that. The second, one of the questions was about, I think I heard some discussion about revenue and profits again. And Sudipta is here, and I will use Sudipta. I'll blame it on Sudipta. Sudipta has come out with a parsimonious model. We know that, it's a very simple thing, like what are you examining? You have returns and earnings, and there are hundreds of variables that affect that. But Sudipta made a choice about a parsimonious model. So it's a parsimonious model, R&D associated with a series of future revenues. And we are trying to identify to what extent is it associated with future revenues. And can we have a better mousetrap? Of course, it is not perfect. And even if you ask the CFO to identify the investment portion, even the CFO doesn't know. CFO spends, let's say, $10 million on training, and ask CFO to identify which portion is operating expense and which portion is investment. Even chief financing officer doesn't know. So I think what we are trying to do is, again, where we stand today, we are making one step forward in science. Of course, not perfect. Buckets we can try. We can try sort of linear estimation. Anil, we can try some MLE kind of thing. Wrong is an expert in that area. In fact, we have another paper on IRR where we are using some more sophisticated methods. So we can try. I think all we are providing is a better estimate. What was the question about 2.8? I forgot. I couldn't fully understand.
But I'm sorry. Yeah.
Your question about 2.78 years of on average.
Yeah, I think the 2.7 or whatever estimates that's again from the in-sample estimates. It just helps you really interpret that.
Yeah, in fact,
happen. Yeah.
In-sample versus out-sample is something that is a major deficiency in the paper today. We recognize that, and we recognize more because some investment bankers read our paper and they said they cannot implement it. And we agree that it's a deficiency. What we have done is we have calculated across the sample period, and then we have calculated averages, and we are using it. In a way, we are using forward-looking data to calculate numbers, which we use to predict future returns. Agreed. And in our next version, we are going to do that. All I will say is that to a certain extent, there is an out of sample, to a very small extent, because what we are using is we are identifying firms that have long time series data, and we calculate industry averages, and then we apply it to all industry firms. Okay, not all firms have long time series data. So to a certain extent, we are from that industry, the firms that have long time series data, we calculate these numbers and we apply it to auto sample, but it is definitely not perfect, because I think in the next version, what we're going to do is we're going to look only on the data that's available today, and can we use that to predict future. So
thank you.
Next, we have a question from Fabrizio.
Hey, Anup, how are you? Good to see you.
Fine, Fabrizio. Great to see you.
We interact a lot on LinkedIn, but it's good to watch your voice. Very interesting paper, and I agree with Stephen that you should push these issues. As somebody who teaches financial accounting every single year, I think about these things when I'm teaching the class. I wanted to go back to something that Stephen said about the impairment, right? That obviously is a very important factor here. So I wanted to make sure I understand your estimate of useful life essentially would be a weighted average of the firms that where the expected useful life goes to the end without impairment, and the ones that have an impairment, right? So it's an actual useful life that you are capturing, because it cannot be a good estimate for an accountant that wants to come up with the expected useful life, right? If 30% of the firms impair and depreciate super fast after 3 years, essentially, it enters your sample as revenue slowing down. So when we think about validation tests, like what Vita suggested, the challenge is going to be that if you apply to firm level, some firms are going to be well above the 2.7 because they actually never impair, and that will be the the percentage that has to take impairments. But if I'm understanding correctly, your useful life is really essentially with the average of the expected and the ones that impair.
So we have not validated that against impairment data. I think we need to think more about it. Possibly that's one angle, but I think what we are assuming is a straight line. So
your revenues will slow down if there's an impairment, right? That's why you would impair, because you realize.
Yeah, that's right. Yes.
So you are capturing the effect of impairments too in your useful life.
Yeah. So I think impairment again in my brain, my narrow area of brain, I consider impairment as a sudden, and amortization is more smooth, where I predictably impair. That's so we haven't done where like AOL Time Warner type $51 billion write-off. We haven't done that, but we should possibly think about impairment as one more validation test. But going back to your point, in a way, what we are saying is that if you have spent $100 today, if the life is 2.8 years approximately, let's say 3 years, about $34 or $35 need to be expensed and maybe capitalize. At the end of the day, you report $60 and then another 30% amortization. And so it produces revenues only for 3 years. I think amongst all the things, that was the most surprising finding that we had in terms of data, that considering 5 or 6 or 7 years of useful life, which studies are using currently. We have seen 7 years also. We do not find any evidence of 7 years for at least for Sgna. So, but yeah, I think with impairment we need to think more about if we can use that as somehow validation.
So I think Levin Sugianis, which is being discussed in the chat, said 5 years for R&D and subsequent papers use 2 years for advertising, not Sgna as a whole, but 2 years for advertising. So that seems to line up pretty well with what your estimates are. And if you look at that table, the 5 years is about right for most industries. That's sort of where it is. A few industries are at 6 and 7, and a couple are at 0, but 5 is a very good estimate across industries. So again, it's sort of, how much are we gaining from?
It is all I will say is this is a debate I had with Shiva. We internally discussed that. Have we solved the problem? No. Have we provided a perfect solution? No. Are we gaining much? It's a matter of taste. It's a matter of taste for those people who are using it. If 505 papers are citing Ryan Peters, who's on the call, his paper, there is a reason, there is a demand. You'll be surprised to see how many emails we have received from investment bankers. We put it out and people are inquiring about it. So people are creating homegrown solutions. So maybe they feel that if there is a better mousetrap, it may not be perfect. Now, going back to Zita, your point about advertising, as we know that advertising is a very small component of Sgna. It's less than 1%. And the useful life of advertising is very small. I think studies have shown that. But think about a company like Facebook, or think about Alphabet. the major chunk is Sgna. Whatever Sgna means, we don't know what it means. Walmart reports $110 billion of Sgna. Nobody knows what's there in it. And so I wish we could identify this. Goes back. I think we have had this discussion when I was writing my management science paper. We sat and we discussed this. We don't know what is there in it. And
employee costs. Employee costs have to be a lot of it. Right? Employee costs are going to be a lot of that, right?
Employees for what? Employees for marketing, employees for innovation, employees for code writing, employees for engineering.
The retail, the store, Walmart stores have employees.
Yeah, but Walmart. What about Google, Alphabet? Again, that's the point, that which bucket, what activity it is for. And so people are using mechanical rules of thumb, and we have provided slightly better mousetrap. And I think we do not want to make too much out of this, but for consumers of financial statements, all I will say is this is a very big thing. They're trying to scrape pennies in their trading strategies. They want, even if they can improve it by 1%, they're fine.
This is a very nice discussion. I don't want to be rude, but Anup, you have 2 more minutes to go. And one more question from Ryan.
Hey, Ryan, great to see you.
You as well. Very nice. I forgot to take my hand down. I was going to talk about the forward-looking stuff and out of sample and thinking about rolling, but it sounds like you're already working on those issues, especially on the asset pricing regressions. The asset pricing people will get you there. Of course, we've got a paper with Dongmei and Hussein where we sort of show that's not an issue here. So maybe you can rely on that and kind of sidestep a little bit there. But very nice paper, and maybe we'll wait until both of our papers are published before we do the direct horse race, so we can say, oh, we don't know.
Yeah, I mean, the point is, it's nobody knows what's a perfect answer. People are approaching it using different. It's like trying to reach Everest, and people use different ways to reach.
I think your guys' approach is awesome. So I've actually told people in certain settings that the approach you're taking here is probably more appropriate for what they're trying to do. I think sometimes your approach makes more sense. I think sometimes our approach makes more sense. These are very hard questions, no doubt.
So I think I will summarize by saying that that there is a great demand for it. I think, I'm sorry to say this, and I know Steve is here and Sudipta here, and some big luminaries are there on this call, but we haven't been able to propose a solution, and the world has changed a lot. I always say that, just FANG plus Microsoft is worth $10 trillion. I live in Canada now. That's 6 times Canada's GDP. We cannot ignore these issues anymore. And people, the users of financial statements, are creating homegrown solutions. And I'm sometimes surprised to see, how, if we think if you have questions about our method, look at some of the solutions that investment banks are using. You'll start laughing. So I think we haven't stepped up to this cause, and therefore any step in that direction perhaps will be useful. So thanks again for your comments, and Steve and Ayang, thanks for inviting our paper. Ionela, back to you.
Thank you very much for this insightful presentation and discussion. I hope you enjoyed them as much as I did. Maybe we can proceed with the second presentation of the day. So we have Ethan Ruan from Harvard presenting the paper, The Stock Market Valuation of Human Capital. Again, the presenter kindly asked everybody to have 5 minutes uninterrupted at the beginning of his presentation before you jump in with your question. Ethan, the floor, or the virtual floor, is yours.
Thanks so much, Ainella, and thank you, Ayang and Simon, for inviting me to this very neat series of paper presentations. And Anup, thanks for the strategy tip there. I'm totally going to drop off when the questions get hard and pass it to Matthias. I have accidental internet problems. Brilliant. So let me share my screen, pull up my slides. This is the paper I'll be presenting is called The Stock Market Valuation of Human Capital Creation. This is joint work with my colleague Matthias Rieger at the Technical University of Munich. He's a PhD student there who will be on the European job market this year. He is a fantastic researcher and just a great colleague. I tried to get him to visit Harvard, but COVID got in the way. I did that mostly just because I enjoy seeing him on a regular basis. And so if you are on the market for an excellent researcher and teacher, keep an eye out for him. So let me pull up chat and jump in. So we are talking, our goal in this paper, we ask two questions. First, in the IFRS setting where firms are required to disclose their human capital or their personnel expenditures, can we extract from this useful information about the investment component of this expense? And second, if so, does the market appreciate this information or value this information appropriately? And I appreciate you giving me 5 minutes at the beginning. That being said, I'm happy to take questions as we go. Ayong had asked us to talk a little bit about the policy implications for this. And instead of saving it for the end, I feel like it's actually relevant to talk about it at the beginning because this is a very, very relevant topic right now in the EU and particularly in the US. So, we all know the trope that our CEOs say our employees are our greatest assets. We don't really know that for certain. We do know that they are probably the greatest expense. If you look at this graph at the bottom here, we see that in the EU during our sample period, the dashed line at the bottom is CapEx as a percentage of revenue, and that stayed pretty steady over time at about 10% of revenue. But even in the early 90s, personnel expenditure, what companies were spending on employees was about more than a quarter of revenues, and that's just increased steadily over time. Part of this fascinating debate is about the relevance of GAAP. It's something we teach in our financial accounting course at HBS for MBA students. One of the key takeaways of almost every class is that the economy has evolved in a way that GAAP hasn't been able to keep up. And so The Economist reported in 2018, worldwide, firms had $8 trillion, or about a third of their total assets on their balance sheet were in goodwill. And that's what's on the balance sheet. That's not including these expenses, internally developed intangible capital. So we know that the balance sheet is doing a less and less good job of reflecting the actual assets in the firm as these firms become less capital intensive. And this has clearly created risks. It consists of, we argue in this paper that employment, and I imagine most people would agree that employment expense consists of the cost component, which is largely the money spent to get people to show up to work and complete their task. And then a component reflecting an investment in human capital, which we admit is a somewhat nebulous term. It can be, culture building. It can be, explicit training. It can be development programs within the organization. But we know that this is important. Unfortunately, unlike fixed assets, firms don't own the employees, and so they can't be treated as an asset. These employees are free to come and go as they please, and when they go, the total value of that asset has to be theoretically written off. And as Zingales says in 2000, the wave of initial public offerings of purely human capital firms is changing the very nature of the firm. And so we're starting to see this at the SEC. Gary Gensler has spoken several times about the need for improved human capital disclosures, and yet we've seen very little in the last 30 to 40 years, other than at the executive level. So in 2017, firms started to disclose the CEO pay ratio. My dissertation looks at this and finds that the ratio itself provides little useful information to the market or to managers. The Reg SK was amended last year to require firms to disclose narratives about human capital risk. David Larker has a paper showing that this has been largely boilerplate. And so at this point, we're largely stuck with very few human capital disclosures, and also more importantly, little guidance on what would be next. What should firms be disclosing that could be useful to investors? So there is some prior literature that looks at the setting. We look at this idea of using personnel expenditures disclosed in the EU, and Schiemann and Gunther 2013 show that total personnel expenditures are positively associated with earnings predictability and show value relevance. Zingales, Ballister et al. Argue that a substantial portion of the investment in people goes to human capital creation. And this also contributes to a significant portion of a firm's market value. Edmonds et al. 2011, which is an insanely well-cited paper, shows that employee satisfaction, we argue, as a human capital related intangible, is associated with excess returns. But researchers haven't examined the variation in firms' ability to create human capital, nor have they looked at how whether this investment is properly identified by the market. And, ex ante, we think probably not, because of how nebulous it is, because there's so much that goes into it. And so we think of this as a shot across the bow, our paper. It's a first step to understanding how this input resource, how investing in humans, first of all, can it be measured? Can we identify some component of this? And if so, can we show that the market is missing this? And so we ask specifically, do market participants recognize firms' human capital creation implicit in personnel expenses? We look at contemporaneous stock prices, we look at analyst forecasts, and we look at abnormal returns based on portfolios around human capital investments. And just to give you an overview of our findings, in case I run short, because 45 minutes is way too short a time, but is also a great amount of time. We find that contemporaneous stock prices reflect some of the variation in human capital investment. We actually find that the market is pricing this in some ways, but analysts fail to incorporate the impact of human capital investments in their earning forecasts, and they're actually pessimistic for firms with high human capital investment, which is consistent, which is what we would expect, because again, this is showing up as an expense, so it's immediately lowering firms' earnings without actually showing, without actually any explicit disclosures about what part of that is going into building this asset. We also find that stock prices fail to fully reflect human capital creation, and a long-short portfolio based on these on human capital creation investment returns a valuated investment of 6.5%. Pause for a second and just jump into before I jump into the sample. So as I said, we are looking at the EU 28 sample. This is a similar sample that's been used in prior research. We start with about 124,000 firm years, and we end up with about a little over 8,500 firm years after putting in several restrictions about data availability, as well as how we measure what we're calling our the future value of our personnel expenditure, PEFE. We drop firms with negative values here because it just doesn't seem to make sense. It's likely due to measurement error. Okay. And so just to give you a quick glance at the firms, at the number of firms by industry and by year. By industry and by country, there's no real surprises. This is fairly representative of what we find in the EU, regardless of the data decisions. We find that the majority of our firms are concentrated in France, Germany, and the UK. Again, we have a big sample in manufacturing, followed by non-durables and business equipment. Ayang. Oh, I'm not supposed to say. Sorry, Ayala, you want to go? Ayang, sorry.
Perfect. It's perfect. It's perfect.
I haven't been on Zoom before.
No worries.
Strike one on even. I just want to confirm that this new IFRS mandate pretty much is providing the dollar amount of a personnel expense, but before this mandate, firms actually had already disclosed the number of employees, full-time employees. Is that correct?
Yeah, so I should be clear, because our sample actually goes back before IFRS, and that's always a question that comes up. So yes, they were disclosing number of employees, but the personnel expenditure was also local gaps were also already many countries local gaps were requiring this prior to IFRS, but IFRS also required the total personnel expenditure. Yeah, they standardize it.
So I think one thing, remember the first graph you showed us?
Yep.
The CapEx versus that. I think I would like to see just taking the personnel expense divided by the number of employees. I would like to see kind of like the average rate, compensation rate, because when you think about that, the EU, I would think about those probably a higher skill, higher paid labor compared to other parts of the world. And if you want to see human capital is very important, I think you want to kind of cater to certain type of the labor concentrated in that region of the world rather than manufacturing low hourly rate or wholesale retail workers. I don't know whether that helps you to highlight the motivation for the study, but
I think it would be helpful to look at. That being said, human capital isn't just about the knowledge we create within the firm, right? It's also about it's about corporate culture. It's about creating company loyalty, the devotion to the company to put in the effort. And so, just to give you an example of that actually really changed my thinking recently. I was talking to the chief people officer at a large catering company, like tens of thousands of employees worldwide, and she said that their most valuable employees are the low-wage workers that have stayed there for more than 2 years. When they think of human capital, those are the ones that are driving human capital at that firm, because these are the ones that have these rote processes down, and these are the ones that are going to mitigate one of their biggest costs, which is turnover. And so
can you use your data to test that hypothesis? Can you use the dollar amount of expense divided by the total somehow as a very coarse proxy for firms who hire more lower paid employees versus higher paid to test your culture hypothesis?
We could, but again, there's so many unobservable issues with that, in that at the same time you look at like business equipment, you'd expect like that industry to also have like the more valuable, like per employee, I guess that would have the more per employee human capital value, but the overall human capital value might be different for the low wage work, like an industry in which there are a lot of low wage workers. That being said, it's not clear what the sum human capital, which would have the larger sum human capital. I mean, same thing with labor expense. You have a company like Google, which has a few employees that they pay a tremendous amount, versus Walmart. Well, Walmart's a bad example because they're so big, but versus a retail company that has a lot of employees that they pay a little. But it's interesting. It's definitely worth looking at this. Looking at how these the average wage across time and the average wage across industry, like even industry by country, to get a sense of where the low wage workers are and the high wage workers, and what aspects of this are driving human capital. Because I think even like a determinants model might be worth looking at. Did you raise your hand again, Ayang?
Oh no.
Okay.
Fabrizio has a question.
Oh, go ahead.
I don't want to interrupt. Are you still presenting or?
No, go, please go for it, Pat.
So one question I had was, how shall we think about what's inside this personal expense? Because I can think of two reasons why company may be high on the number, right? One could be what you view as the creation of human capital. They invest more in training, in the remunerate better, they do more education, and more retraining and stuff like that. The other one could be the opposite. They are very inefficient in the labor capital management, in the sense of, you got a lot of employees that turnover, you're going to incur some cost, right? For the people that leave, there's some, severance packages or things like that. And then you have to train the new people coming in, which might make it more costly. So I'm trying to think, is there a way to differentiate why a company can be higher than a peer and interpret that as, investing in capital versus being inefficient? Because I noticed your result on the pessimistic, which seems to suggest that the guys who invest too much don't do well. So I was trying to figure out why.
So it's interesting because so first of all, on the results, it's that analysts are more pessimistic the more they raise, the more the companies invest. But when we build our portfolios, it's the companies that invest the most that are having the positive alpha. But again, that's why I build this as kind of a shot across the bow. The personnel expenditure is a hugely comprehensive measure. It includes wages, bonuses, it includes uniform expenses, training, it includes everything. And so it's really hard to differentiate and identify, what exactly, the explicit aspects of human capital that are in here. That being said, when we think about it from a policy perspective, this is, one of the measures that the SEC is thinking about disclosing. And I think just showing that there is some value relevance is helpful, because again, we're kind of wandering around in the dark, and it's going to be costly to provide any measure.
Next, we have a question from Sudipta.
So I was wondering whether we have information on turnover rates, because I could think of, salary as paying rent on the human capital as opposed to an investment. And so if we have industries or companies with high turnover, that seems closer to renting, whereas if it's low turnover, that's to me closer to investment. So do you have information like that might help you separate, like a operating lease versus capital lease, that kind of treatment.
It's a fascinating way of thinking about it, renting the human capital. But the short answer, Sudipta, is we're working on it. We're trying to actually get firm level turnover data. In absence of that, we are thinking also about, you know, even just using a proxy for industries with high versus low turnover. I think it's a worthy venture, because but I'm curious as to your thought as to, you know, when looking at that relation between turnover and the human capital investment, you know, is it that industries, the leaders in industries with high turnover would have higher human capital investment to mitigate that? Or is it that we'd expect the industries with lowest turnover to have higher human capital because they have a lower human capital risk?
Well, I think if you're thinking, say, about corporate culture, maintaining a culture is just higher, more costly, you know, when you have higher turnover. So, you know, in Anoop's terms, you're expensing your impairment very rapidly. And so you may be spending more, but that doesn't mean that more of it is investment, right? I mean, you may be spending more, but most of it is being used up as people leave. And you've got to sort of spend on the next set of employees. So I'm not sure that it's investment if it doesn't last very long.
Yeah.
Right. So, so I think of it more as, you know, are we renting the human capital? As you say early on, the employees own the human capital. They can leave whenever they want. So I think of salary as basically a rent that you're paying for the human capital. And so it's really difficult for me to think of where is it that the company is actually investing in human capital. You know, I mean, there are certain things about synergies between people that I think belong in the company, but sort of the, you know, what you do in terms of that, that's much harder for me to get hands on. But, you know, like knowledge management systems, I understand that is an investment in human capital, but salaries per se.
It's helpful to hear you think about that. It's also helpful to hear you suggest turnover, because it gives us a point to focus on. Thank you. So anybody but Trevor?
Only Trevor.
I can only be helpful to you.
Good to see you, Trevor.
You too. The thing I would caution you on in reaction to some of these comments, but also just the whole thing you're doing, is there are employee cultural differences across these countries. And so if you take something like turnover, there's a whole individual country element to that, aside from what individual companies will do. And that also has been evolving over time. So it used to be, for example, that the labor was very immobile. And then with the EU, there was much greater mobility. And so that created, so there's a dynamic that goes on, as well as, you know, within the wage rates or salary rates that are paid, and the degree of sort of competition and so on. So it's a much more complicated, and I know you know this, but in addressing some of these questions, you want to be a bit careful about how you aggregate across all these different regions, as well as obviously sectors.
And it's something that's been keeping me up at night as well on other projects, because we are trying to think about, you know, employee safety and well-being, trying to develop measures of that internationally. And, you know, in the US, you can use minimum wage as a proxy for a lot of things because there's variation, but there in the EU, you know, it's more of a social safety net as opposed to a minimum wage that's really important. So I agree that it's, you know, you can't make generalizations about employment in all of these countries, and it is a huge challenge in what we are doing.
It wasn't meant as a criticism of what you were doing.
I
was just saying, as you address some of these issues and you try to control it, you want to be careful about overdoing it.
I mean, yes, I agree. I think, you know, we can control for, you know, we could do a country fixed effects in our regression, something like that. But we do need to at least acknowledge that there are significant differences in employment in all of these countries, and that will, without a doubt, impact human capital and how firms think about it. Okay, so there are two ways, just diving into the financial statements for this accounting group. There are two ways that firms can actually disclose this information. There's the function of expense PE disclosure in the financial statements, and this actually breaks the personnel expense down in the footnotes. It's kind of lumped into much like what we see in the US. And then there's the nature of expense. And this one is a little less familiar to us US GAAP people. But here they actually explicitly report the personnel expenses on the income statement. Again, this doesn't really, this is for edification purposes. It doesn't really affect our analysis. We have these data regardless of how firms disclose this information. But you can see that it's almost a philosophical question of how firms think of how firms think of the expenses that they actually incur. And so jumping into our measurement here, measuring human capital investment, we follow we adapt prior literature largely rely on Banker et al. 2019, which is extracting investment components from an expense. To do this, we regress operating income on prior periods personnel expenditures. We control for employment to make it scale, basically to control for the scale at each firm. And what we do is then we determine the ideal structure at the industry level. So basically we run these regressions until we find the coefficients stop loading on the prior periods personnel expenditures, stop loading on current operating income. And then we aggregate the coefficients to create our measure of interest, the future value of the personnel expenditure, PEFV. And so this just shows the optimal industry lag structure. As you can see, there are some. This is actually fairly similar to what Banker et al. Find when they look at Sgna, but you can see that there are longer period, there are industries with much longer periods of investment, and firms and industries with shorter. So manufacturing, wholesale, retail, they have the longest, while chemicals, which is a process, a long held process, has the shortest. Consumer durables is in the middle. There's one where innovation is important, but it's also slow. And just going into some descriptives, so on average, personnel expenditures is about $729 million a year for firms. We can see that the PEFV is, the mean is about 2.8, and it's slightly right skewed, but it's fairly well distributed. We also look at two other measures. So we look at personnel expenditure divided by total assets. And lastly, we interact the two, which we think of as a combination of the opportunity to invest and the investment itself. So the personnel expenditure is the opportunity to invest, how much that it can actually put into employment. And the PEFV is our proxy for the investment itself. And so first we do a gut check. We see whether our measure is correlated with other metrics that we'd expect to be related to human capital. And so we find results fairly consistent with this. We find that the number of employees, so smaller firms actually have higher investments in human capital, as do growth firms, firms that are with fewer tangible assets. Firms with more personnel expenditures and higher average mean pay. And also for a small subset of our firms, we actually have the number of training days that they have. And we find that this is positively associated with our PEFV, which is a very encouraging thing for us. Next, we regress price on our personnel expenditure and PEFV. And we find that, again, the current expenditure is negatively associated with price. Again, this is consistent with it just being treated as an expense, but we do find that a positive coefficient on PEFV, meaning that at least to some extent, the market is acknowledging this investment in human capital. Next, we look at, so in our last set of analyses, we turn to this idea of, is the market acknowledging this? Does the market realize this? And so, as I said, we look at analyst forecasts first. We look at the absolute value of their forecast errors. We find that it's positive. This suggests that as the investment in human capital goes up, overall analysts just make more mistakes, but this is being driven by analysts being pessimistic on either being pessimistic on these investments or just not acknowledging these investments. Basically saying that we find that the personnel expense, we find, they're treating it as an expense. Personnel expenditure drives down income, and therefore they're more negative about these things. Bad.
We have a question.
Sorry. Sorry, I know.
I was thinking, this reminds me a little bit of the work that was created by Michel Harlon and Raj Gopal back in the day, kind of looking at the effect of investing in, employee stock options and future performance, And one of the issues in this type of study is always this reverse causality, right? That if I expect good performance, I might hire more people. I just need, I need more salespeople. Does that play into your model? Maybe and really follow the econometrics closure, or is there an issue that face?
I don't think that's a huge concern because we're controlling for employment. So I mean, if firms are staffing up, if it's solely staffing up in expectation of better future performance, that wouldn't be reflected in our measure of PEFE. It's more just, it's not are we hiring a bunch more people? It's that are we investing in people regardless of whether we're hiring a bunch more people. Okay, so next we look at we do our portfolio sorts. We sort firms based on we start with PEFE and then look at the intersection of PEFE times PETA. So basically, we look just at the human capital investment and then look at the combination of the human capital investment and the total expense, the opportunity to invest. And we find pretty large value-weighted returns. So on PEFE, we find the annualized return of 6.5% on a long-short portfolio, and it goes up to 7.8% when we combine the two. Now, we do a bunch of robustness tests for the portfolio analysis and cut it in various ways. Focusing on the value-weighted portfolios, we find that sorting by Fama French 12 industry is about we have returns about 4.5%. So again, one concern here, we do have some bunching among industries. There's just higher concentration of some industries in some of the portfolios, but this is a way to get around that, and we find that our results still hold. It's the entire EU, so there are countries with fairly illiquid currencies, and when we exclude them, our results actually increase, suggesting that this is driven by the most healthy and robust markets in the EU. When we exclude the value factor, our results hold, including momentum in the Fama French model. We again find similar results. Lastly, one concern that we continue to wrestle with is when we show the ideal lag structure, it varies by industry, and we could be introducing some bias by just making that choice. And so we also rerun our results using just a uniform 2-year lag structure and a uniform 3-year lag structure for all firms. And again, we find that our results hold. So the results aren't being driven by the choices we make one of the most important choices we make in our model. Next, we look at long-term portfolios based on PEFE and times PETA. And here again, it's the idea is does this expire over time, which we would expect? And this kind of gets to a little bit, at least, concerns about reverse causality as well, because if it's just firms staffing up, we'd expect these results to go away, not to go away over time. Same with if the measure is particularly sticky, we'd expect these results not to go away over time. And this, gives us confidence that that's not the case. We find that the most action happens in the first year of portfolio formation, and it monotonically decreases over the next 2 years. So lastly on this, I should say, we look at we look at cross-sectional monthly returns using Fama Macbeth model, and again, our results are again similar to what we found in the portfolio analysis. We find significant positive returns based on our quintiles of PEFE and our interaction of the two variables of interest. And so lastly, our measure mixes ex ante uncertain investment with success of that investment. We acknowledge that, and clearly this can introduce some bias. And so in our final robustness test, too bad Anoop's not here, because we use his paper, and we follow his 2017 management science paper to reduce concern about bias. We adapt his methodology and calculate the portion that's expected to create a future benefit in its relation to sales and income. And here again, we find that the results hold, although they're not as strong. Our portfolio results are a little weaker than they were using our methodology, which suggests that, again, our methodology may have some bias concerns, but it seems like an efficient or an effective way of at least starting to get at this measure of human capital investment. So just to sum up, we know this is an increasingly important component of a firm's investment operations, but it's not treated as an asset. There is a tremendous amount of discussion right now in the practitioner space, as well as among regulators, about what should be disclosed. And in the conversations that I've had, total employment expense is almost always the first thing to discuss, followed by turnover data or information about employee turnover and information about investment and training. And so these are all related to human capital. But what we show in this paper is that this could be a useful measure for additional disclosures, to improve disclosures in the United States around human capital. It's quantitative, it's easy to understand. It's also easier, I should say, for firms to calculate and disclose without concerns related to proprietary information. And so in this paper, we identify a strategy for identifying from this disclosure our investment in human capital. And we finally find that market participants fail to recognize the human capital investment component inherent in these personnel expenses. So on that note, I will sum up. I will leave this slide up. I'm happy to take any more questions, but do you want me to talk about next week? I'll just do it. So next Thursday, 11 to 12, my friend and former classmate, Venkat, the China Europe International Business School, will be presenting his paper, Estimating Maintenance CapEx.
Thank you very much. If there are no more questions, it seems that we are very efficient. No, Fabrizio has a question. And Zachary, okay.
If I have 5 minutes to give him a hard time, why not?
I was about to say, I would expect nothing less.
No, so I think, I can't follow things on Zoom as well as I can do in person. I apologize. I think I might have missed the definition of PEFB. So isn't that based on future operating income, essentially regress on current investment in expense?
So yeah, I mean, that's what we say. Yes, it's operating income. Current period operating income regressed on prior periods personnel expenditures.
But then
sum up the
it's a measure of efficacy of that investment as a proxy for rather than a proxy of the investment. I mean, isn't that in itself?
Yes, yeah, exactly. It is. It's a measure of the efficacy of that investment.
But then, I mean, I'm trying to link it to the issue of disclosure of intangibles. And so, I mean, is the policy recommendation you need disclosure of successful investments?
No, I will definitely not. I think the policy recommendation is that a first step to human capital disclosure is disclosing this total employee expense.
Okay.
There is information in employee expense that's value relevant.
Zach, do you want to ask your question?
Yeah, thanks. And I think another interesting paper on intangibles, and I think really you're exploiting sort of a line item that we don't have under US GAAP to address a really interesting question that I think is really cool about the paper. So related to the same regression where it's operating income on personnel expenses and number of employees, I was just, when I'm thinking about human capital as an intangible asset, I'm thinking about using that human capital in combination with other things, sort of like maybe the human capital is related to the research and development program, and they're sort of being combined together to generate operating income. And I was wondering if you had thought about including other expenditures in that regression to sort of account for these other items, but still the focus would be on the coefficients on personnel expenditures. But Just wondering if you'd.
Yeah, no, it's a good suggestion, Zach, that we really haven't thought of. Like, it's kind of like the Core and Gay when they regress like a bunch of characteristics, including governance measures on CEO compensation, then just sum up the governance characteristic coefficients as the proxy for governance issues. Is that what you're suggesting?
Yeah. So then in that respect, it would be sort of the effect of personnel expenditures incremental to other items that may also be driving operating income.
Yeah, that's one way we can do it. We've actually talked about this because to also differentiate ourselves or show that we are incremental to the banker at all paper, and we in some robustness tests we control for Sgna to show that this is above and beyond what they're finding in Sgna, but even including it in the regressions would be an interesting way to explore that. Yeah, thank you.
Thanks.
Trevor, do you want to unmute yourself and ask your question? If Ethan
Yeah.
wants.
Ethan has no choice, I'm afraid. So, Ethan, one of the things that I would suggest you think about, these capital markets in these different countries, and certainly the nature of analysts' forecasting, are not uniform by any stretch. And I think you could choose a few of them. I don't know if the data sets are sufficiently large, but if you chose a couple of the markets where there's clearly well-developed capital markets and well-developed sell-side analysis, and take the others and see if you get the same results, you might find that they're actually a little different.
That's a great. Oh yeah. Go ahead.
No, so I just think it would. I'm not sure what it will do to the results, but I just think it would be, if you find it's the same, that's interesting. But I think you might find that there's a differentiation.
Yeah, that's a great suggestion. As I showed in the robustness test, we just drop out a few countries with the illiquid currency countries, but even segmenting it farther and doing kind of almost a cross-sectional analysis of the most well-developed versus some of the lesser developed.
Yeah, it's just do subsets. I mean, I wouldn't do a full cross-sectional thing. Just take some subsets of countries where you have some basis for understanding the capital market structures in different ways.
That's great. Thank you.
Thank you. Anup?
Yeah, Ethan, I'm going to ask this question. I've troubled you enough in past, but I'm going to ask you something that I faced and I don't know how to implement it, but let me offer it anyway. I think where Zach was going was, what he was saying was that operating income is a result of, let's say, just two factors of production. One is knowledge and the other is CapEx, PP&E. And so operating income comes out of these factors. And perhaps what training does is it improves the efficiency of utilization of PP&E. So perhaps that interaction effect is the one that creates value. I thought that's where Zach was going. Now, I know that in a parsimonious model, you have to think about where to stop. Again, for example, advertising can enhance the profitability of certain products that are already produced. They can create brand equity, price premium, so on and so forth. So it's the interaction that becomes interesting. Now, having said that, I know that the same thing should be applied to my own past papers, but I haven't applied. But let me throw it out anyway.
Is this the time where I pretend like my internet falls out again and pass it over to Matthias?
No, you can't try that. I've done it.
No, it's a great suggestion. And as you say, the big issue is where to stop, because we can throw in every expense, we can throw in every expense and every investment. And I guess my pushback is really just, if it's the interaction of investment in humans and PP&E, do we want to control for PP&E, or do we want that to be captured in the betas that we're actually investing in? Because again, that's human capital. It's not, the machines aren't getting smarter, it's the people using the machines who are getting smarter.
Yeah, where I was going was that interaction effect should also be in your betas. And maybe because of omitted correlated variable, it's already there.
Yeah.
But that's where it creates value.
Okay. Thanks.
We have one more question from Sudipa.
So a couple of questions. One is that the personal expense is part of operating income, and a company or a country where personal expenses are a larger share of income, would that affect your coefficients and your estimations? Should you be looking at operating income without personal expenses? And the second question or suggestion following what Trevor was saying was maybe think about sort of this, the grouping of code law, common law, or socialist versus other countries, and think about, how labor laws in different countries would cluster or use labor protection laws. Say there's another banker, Basilov, etc. paper in 2013 in JEE that would allow you to sort of get at some of the issues that Trevor's talking about.
Yeah, what we were talking about at the very beginning as well, like the thinking about not just the type of work being done, but the social safety net, or how companies, or how employees are both incentivized and how their unemployment risk is mitigated would be helpful. On the first one, so we look at operating income in T and look at our investments in or the personnel expenditures in T-1 on and on. But so we can't directly pull out that the expense component from operating income for all those other ones. That being said, we know that while the PEFV is not particularly sticky, personnel expenditure is really sticky year over year. So that's a good suggestion. So thank you.
Thank you. Are there more questions or?
We're out of time. Yeah.
Yeah, 3 more minutes, but yeah. Okay.
Well, thank you also. This was super duper helpful and fun. It's so nice to see so many people, although it makes me pine for the old days. So thank you, Ayong and Stephen and Ainella and everyone else.
Thank you very much.
Yeah.
And see you next week.
Yeah, see everyone next week. Thank you, Anup, Ethan, and Nella. Thank you everyone for asking questions too.
Thank you.